I had given you an homework. The homework was the liquidity risk of the banks arises from. So from where does this liquidity risk arise? Funding of long-term assets by short-term liabilities. Funding of long-term short-term assets by long-term liabilities. And funding of long-term liabilities by short-term assets. And none of these. So what is this? Funding of long-term assets by short-term liabilities. Let me explain you. Okay, let's consider two things. One is deposit. Okay, keep it very simple. We always believe in keeping the things simple. Okay, so deposit. Let me call this loans here. Many of the bankers don't understand assets. Here, loan is actually the asset. Deposit is actually the liability. So what is the option number A? Funding of long-term assets by short-term liabilities means what? Liability is deposit. Suppose if I am having 1 year deposit and I give a loan of 3 years, means 1 year I am having 1 lakh. Okay, this is the deposit which I am having, FD. I give a loan of 1 lakh for the 3 years against this FD. Am I doing the right thing or wrong? What do you say? Just type yes or no. Am I doing the right thing? Yes or no? I am giving loan of 3 years against the deposit of 1 year. No, I am not doing the right thing. Why? Because this asset deposit, this deposit person will come to me after 1 year, give me my money back, and this loan person will give me when? He or she will give me after 3 years. So this, what will I pay to this guy after 3 years? So A is definitely the answer. Funding of long-term assets by short-term liabilities. Second, funding of short-term assets by long-term liabilities means what? Suppose if I am having a FD of 3 years for 1 lakh and I give a loan of 1 year for 1 lakh. Am I in a problem as such? Will I face any problem? No. Why? Because this person will come to me after 3 years for his deposit, his or her. But this person will pay me within 1 year. So I am not in the problem over here. So this is not the point. Funding of long-term liabilities by short-term asset. This is absurd. How can I fund a liability from an asset? It's always the reverse. Assets are funded by liabilities. Loans are funded by deposits. Okay. So this is strictly out. Okay. So answer is A. Funding of long-term assets by short-term liabilities. Everyone understood it? Understand the meaning of this first. If I take a deposit of 1 year and give a loan of 3 years, I will be definitely facing the problem, isn't it? Okay. The risk of adverse variance of mark-to-market value, of change in market prices, of interest rate instruments, equities, etc. is called as what? Price risk, market risk, translation risk, both A and B. A and B over here. So it is called as what? See here, mark to market means what? Whenever I have a change in the market price of the stock or any commodity, the change, how does it affect me? For example, let's say I am having a Reliance share. Okay, Reliance. Today it is 2000. Imagine. Tomorrow it is 2050. So mark to market I am having a profit of 50. Day after tomorrow it becomes 1900. So mark to market I am having a loss of this 2050 minus 1900. I go on and on and on over here. Okay. So this is definitely a price risk because we are dealing with the price. So A is the answer. What about B? Market risk. Yes, that is also the risk. Why? Because is this in your hands? The Reliance price or any, let's say not only Reliance price. Let me call anything. Let me call it bonds. So is the bond going up or down? Is it in your hands? No. So that is known as a market risk. Whatever risk you can't control, okay, which is not in your hands, is known as market risk. So the answer is understood. Type yes in the comment section. Answer is D. Type yes in the comment section if you have understood it. Everyone type yes. Okay. Move on. Shall I move on? What is not a forex risk? So not a forex risk. Which of them is not a forex risk? The risk which may arise due to favorable exchange rate movements in the forex risk. So if it moves in the favorable direction, so is it a forex risk? Means what? Suppose if I have, let's say I have purchased dollars. Okay, purchased dollars at what rate? equals to rupees 80. Okay. Now if the rate goes up, favorable means it should go up. I have purchased it, so I have to sell it. So while selling, if the rate goes to 90, so is it good or bad for me? So it is good. So whenever a market rate moves in favorable direction of mine, then it's not a forex risk at all. So A is out. It is not a forex risk which arises due to favorable exchange rate is called a forex risk. So this is not a forex risk. So this is true. This is the answer. This occurs on account of open position in spot and forward contracts. Yeah, that is the true. That is actually a forward forex risk. Means what? Whenever I purchase this dollar at 80 and hold it with me for EOD, end of the day, I hold it with me. I don't sell it within the day. Within the day is called as intraday. So I don't do the intraday transactions. I keep the delivery position. So whenever I keep the delivery position, the point over here is I am taking the risk for the EOD, and that is called as open position. So this open position is always susceptible to forex risk. So B is true. I want false. I want not. So A is answer. But what about B? Because all of these is also the option. So B is not the answer. Because we want not a forex risk, and this is a forex risk. It is applicable to individual foreign currency. So it is definitely applicable. I am buying any dollar or pounds or German currency or France currency, franc, anything I can buy. So whichever I am buying, or euro, whichever I am buying, okay, it is always the forex risk always applies to all of these, isn't it? So the answer is not even C. So the answer is only A. Okay. Before moving ahead, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus current affairs, job alerts, live classes, ebooks, tests, everything you are getting. Whatever is required for clearing JIB and CIB, you will get it over here. So download it right now. Okay. When an asset maturing in 2 years and a bank does not have equivalent liability for the same period, then the liability risk will be. Now this is something difficult. Okay, means what? Asset is maturing in 2 years, means loan is maturing in 2 years. Loan is for 2 years, but I don't have equivalent liability, means I don't have a deposit for 2 years. See here, what does the RBI bucket system tell? There is something called as bucket system. Bucket, RBI has given the bucket system. What does that bucket system say? You must have equivalent deposit for equivalent loan. So if I am not having any deposit over here, then which is the risk which I am faced with? Credit risk? No. Credit risk means basically this is related to the counterparty risk. Means if I give the loan and somebody doesn't give me back, so that is not out. Okay, let me get the answer from you guys. Otherwise what happens, I'll answer everything and you'll just listen. Is it a yield curve risk? Is it a gap risk? Or is it an embedded option risk? Now answer between B, C and D. Let me see. B, C and D. Okay. Let me give you the hint also. Yield curve risk is out. Okay, so this is also out. Now it's very simple. Yield curve risk is out. Why yield curve risk is out? What is the yield curve? Yield curve means bonds. Okay, it is related to bonds. So it is similar to that of that price risk or market risk, which is not in your hands. Okay, so that is out. What about this C and D? Now this is what you have to answer. Gap risk and embedded option risk. You need to understand the meanings of this. Everyone? Embedded option risk means what? Embedded option risk means if I am having the FD of any bank, is it compulsory for me to go to that bank and for maturing breaking this FD only after maturity, or can I go tomorrow also? Type yes in the comment section if I can go tomorrow. I am having a FD of your bank. Okay, your bank only. What do? Can I come tomorrow in your bank and bring that FD and tell you that, see, this is my FD, take this FD and give me my money back? Can I do that? Yes or no? Yes, I can do it, because after all it's my money. So that's known as embedded option risk. So that is out. This has nothing to do with this loan and deposit mismatch. Okay, so the correct answer is gap risk. Gap risk means what? If there is a gap between the liabilities and the assets, or loans and deposits. Okay, so that gap is known as gap risk, and it further escalates to the income, net interest income. So that will again affect the financials of the bank. So the correct answer is gap risk. Okay. Liquidity risk is defined as what? Excess of liabilities over assets. We did this question, similar question earlier also in homework, right? But this is different. Excess of liabilities over assets. Excess of long-term liabilities over long-term assets. Excess of short-term liabilities over short-term assets. So is this a liquidity risk? Excess of liabilities over assets means, let's say, short-term, long-term, both of them. Okay. So excess of any liability over any asset, is it a liquidity risk? Of course it is a liquidity risk. Why? Because if I am having more liabilities, let's take one simple example. Okay, loans, always bank always moves between these two parts only, the loans and deposits. Okay, so if I am having a loan of 100 rupees and deposit of, let's say, 200 rupees, so will I face a liquidity risk over here? Definitely I'll face. Why? Because here I'll be getting the interest. Let's say both the interest rates are same, 8%. So here how much money will I get? I'll get 8 rupees at the end of the year. How much money will I pay? I'll pay 16 rupees at the month year end, right? So where will I bring this extra 8 rupees from? So that is basically the liquidity risk. So excess of liabilities over assets of any form, short term, long term, or anything, that will definitely give you rise to liquidity risk. Got it? Liquidity risk in bank manifests. Manifest means comes in different dimensions. Which are these? So liquidity risk in banks comes in what all dimensions? Funding risk arises from need to replace net outflows, withdrawals, and non-renewal. Means funding risk. Okay, means non-renewal of FDs. That can also be a problem to me. Time risk arises from the need to compensate for non-receipt of funds, means NPA. Means what? What is this time risk? Suppose here, if I have given a loan to somebody, okay, so what do I expect? Let's say I'll get the EMI here, all these EMIs I'll be getting. So based on these EMIs, I'll place my further calculations. But if some EMI does not come over here, what will happen? That is a time risk then. That becomes an NPA. And then I don't have money for further transactions. So that is my issue. So that is actually the time risk. So liquidity risk arises from non-payment of EMI, or you can call it NPA. Crystallization of contingent liabilities. So crystallization means what? Suppose if I have given a guarantee to somebody. Okay, how does the bank function? See this. Suppose this is the bank. Okay. Let me explain you. Bank, this is my customer. Let's say that customer is a contractor, road contractor. Okay, contractor, and that person has taken the contract for some state government. Okay, state government, he has taken some road contract. Okay, so state government asked this contractor, we will give you the contract, but subject to you give us a guarantee from a bank. So my bank gives them the guarantee now. My bank, on the basis of the contractor. So of course I won't give this guarantee free of cost. I'll be taking FD from that customer. FD, right? I'll be taking FD from that customer for that amount, and in fact more, 110%. Now if the contractor does not build the road, okay, so what will the state government do? This state government will come to me. You had given me the guarantee, this person has not performed, give me my guarantee amount. So this is known as crystallization. When the state government comes to me, or any party, the state government is just an example, any party comes to me based on the guarantee which I have given. So that is known as crystallization. So liquidity risk in bank will arise because of all these three. So the answer is what? A, B and C, all of them, isn't it? Got it? Now subscribe to Officers Adda 24/7 YouTube channel. In this channel you will be getting the latest updates on JIB, CAIIB and all the banking exams. Second, free YouTube series. What are you watching right now? Right now you are watching what? You are watching the free YouTube series on this BFM. Similarly, on all the subjects you are getting the free YouTube series over here. So click on the bell icon immediately. Subscribe to the channel. Because whatever is available free, grab it first. Rule of life is simple. Whatever is free, get it first, isn't it? The features of the basis risk are, okay, so see this. Features of the basis risk means, what do you mean by basis risk actually? What is the difference? What is the actual meaning of this basis risk? So let's deep dive over here. So this, the features of the basis risk are when the interest rate of different assets, liabilities and off balance sheet items change in different magnitudes. It's called as basis risk. Means assets and liabilities change in different magnitudes. What does it mean? If my loan goes ahead with 2%, suppose if I am having 8% rate of interest, okay, for loans, and deposit I am having, let's say, deposit will always be lesser than loans, okay. Let's say I am having 6%, okay. Now if deposit moves by, let's say, 2% above, okay, it moves to 8%. And this loan moves by 9%, means 1% only, so it moves to 9%. So what will happen? Earlier I was earning 2%, now I am earning only 1%, right? So this is what? This is my basis risk. When the deposits and loans change in different magnitudes, that is called as basis risk. That's the option of A. So is it correct? Let's see. B, when the interest rate of asset rise in different magnitudes as compared to interest rate of the corresponding liabilities, which may result in variation in NIM, net interest income, it would be basis risk. So is this also true? The basis risk is quite visible in volatile interest rate scenario. Volatile means ever changing, constantly changing. Presently we are in volatile interest rate scenario since October 2022. After that, Russia-Ukraine war started heavily, okay. So we are in volatile interest scenario, okay. What is volatile interest rate? It moves very high, falls very high, moves up, moves down very fast. So what are the options over here? A, B or C? What do you say, guys? Type yes, type in the comment section A, B, C or D. Is it all of these? Everyone? It is? Obviously D, right? All of these are correct. Both A and B mean what? Roughly they mean the same. Assets and liabilities should move in different directions. And third one, volatile interest rate. The features of embedded option risk are, when the bank is exposed to risk due to prepayment of loan and premature withdrawal of term deposit, it is called as embedded option. Means what did I say yesterday in the beginning somewhere? That if I am having that FD with you and I can come to your bank tomorrow morning, take this FD and give me my money back. So that's embedded option risk. Similarly in loans also, if I am having a loan from your bank, tomorrow morning I can come that this is my money, take this money and close my loan. Nobody can question me, okay. So that is the option available. So A is the option. What about B? This can be experienced in volatile situations. Now again, volatile situations here, these things happen in volatile situations. If the interest rates move too high, too low, then the depositors and as well as the loan takers, okay, both of them are always in a confusion. They always try to close their loans as fast as possible if the interest rate goes up, okay. So this can be experienced in volatile situations. Yes. The greater the magnitude of changes in the interest rate, the higher will be the embedded option risk, isn't it? Greater the magnitude means if the interest rate changes very high, very low, from 8% it goes to 10%, or from 8% it goes down to 5%. So definitely that's a high magnitude. So if interest rate moves in such a high magnitude, depositors and loan takers will definitely try to close their obligations with you, okay. So the answer is what? C is also the answer. Answer is all of these, isn't it? Don't you feel? Type yes in the comment section. Everyone, just give me 1 minute and type yes if you have understood the topic. If you have understood the questions which I have raised, type yes in the comment section. Everyone. Even if you are watching the recorded session, type yes. Okay? So that I must understand that whatever we are teaching, we are on the same page. Now let me come to the batches. See, these batches just now started. Selection batch, ABM, BFM, ABFM, BRBL, all the 4 subjects. numericals, objective questions, case studies, everything is taken care of. Okay, 80% discount is going on and double validity on Mahapacks. What is Mahapack? 15 plus batches. See, 15 plus batches. Okay, this is the beauty of Mahapack. Double validity is going on, means if your Mahapack is for 6 months, it will be there for 12 months now. Use the code Y432. Never forget this code, because this code is the only thing which will give you 80% or 81% off. Why 81%? If you are having the app and you are having the coin system, you will get 1% extra, 81. Let me show you how to get it. Okay, let's go to Adda 24/7. Let me go to Adda 24/7 first. Okay, hold on. If you are having the app, I would suggest download the app first. I would suggest to everyone download the app. Okay, okay. Let's go to Adda 24/7. See this, right? In the app, you can go it. This moving is very fast. Okay, so JIB and CIB. Click on CIB 23. Clicked. You'll see the CIB 23. You'll see the batches. Click on this batch, English batch. Okay. You'll see the details. What are the dates? What are the timings? What are the study plans? Everything you'll see it over here. It's two-way interactive classes, so you can ask the doubts there and then itself. 24/7 recorded videos are available. So, what does it mean? 24/7 videos means if you miss out on any class, you can definitely get back to the class. Okay. Using the recorded sessions. Now look at the discount, 5279, 78% off. Earlier fee was 23,999, then it came to 5279, 78%. But don't settle. I'll give you more discount. Click on more offers. Put the code Y432. Never forget this code. Click on apply. Look at this, 80% off. 23,999 reduces to 4799. Such a huge discount you are getting, guys. These discounts are not available every now and then. Even you can go for Mahapack. Mahapack is 15 plus batches. See this. Okay, 15 plus batches you are getting. See this, Mahapack. Go to Mahapack. Okay. See the JIB CIB Mahapack over here. Click on JIB CIB Mahapack. See this. Click on CIB ka Mahapack. You'll see 15 plus batches over here. Okay, read the details at your ease. You are having numerical batches separate, tests separate, everything you are getting it over here. Now, let me go to the fees part. 7699. See here, 34,999, 78% off, 7699. But again, don't settle. Let me give you 80% off. Okay, click on more offers. Put the code Y432. Click on apply. Look at this. Now look at the validity. 6 plus 6 months, double. Plus the fees part, 6,999. So click on continue, pay the amount and go for this Mahapack. I'll be back tomorrow with another session. Till then, keep studying, and importantly, everyone join the batches, because exam is just in June. Portion is new, subjects are new, and it's not possible for single-handedly to attend these, clear the exams. It's very difficult. In fact, somebody can do it, but it's very difficult in the new portion. Okay, bye.